Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, other key points really in terms of the fundamentals. Ultimately, capital flow, is the key. We do a lot of the fundamental analysis to try and determine, one, what the consensus thinks. Number two, is the capital flow likely supporting the consensus? The answer would be yes, because if it wasn't, prices wouldn't be moving in line with the consensus. But ultimately, sometimes the fundamentals get kind of odd in terms of, especially in the shorter time frames you get in. The best example of this, I think an example is best to explain this. During the credit crunch, the U.S. Of course was said to be the source of all the problems in the world because of the credit crunch, because of the derivatives, and I think everybody knows that story by now. But in general, most people looked at that and said, well, the fundamentals are so bad in the U.S. that the U.S. dollar has to crash. But what happened was the capital flow underneath the surface really changed the game, which was quite different from the headline fundamentals. Sure, the U.S. Was in terrible shape and the headlines were awful during the credit crunch, but in terms of a capital flow basis, because the U.S. dollar is unique as a world reserve currency, and because the U.S. capital markets are unique because they're so deep, capital had to flow back into the U.S. As all these major players in the world needed a place to hide and store money, and therefore the U.S. dollar rallied. So be careful. Ultimately, capital flow at points in time will trump both your technical and your fundamental analysis. Also keep in mind, fundamentals can be very short-lived. 1 week we can think one thing, and the next week we can think another. So, we have to be careful there. Just because we call them fundamental analysis doesn't necessarily mean that they're any more important than technical analysis or any more valid, because things change very, very quickly. Monetary policy changes, risk appetite in the world changes, especially now. Events can change quickly. But in general, if we continue to keep our focus on interest rates and longer-term economic growth, I think we can focus on fundamentals that aren't so short-lived. But keep in mind, this can change quickly too. As I said, actually as I didn't say, one of the things you have to remember is fundamentals, and the reason these things change is fundamentals and price form a feedback loop. And let me explain that a bit. Rising prices tend to lead to what's believed as stronger fundamentals, because rising prices in markets tend to increase the collateral value, underlying collateral value for loans. More loans tend to lead to more rising prices. Rising prices tend to create higher collateral values. It's the same thing on the downside. Falling prices tend to reduce collateral values. Banks call in loans because the collateral has fallen. People take money off the table in order to support the collateral. Prices falling further push fundamental values down because of collateral. So you have that constant feedback loop, prices and fundamentals, and it's very much apparent in the currency markets. You tend to see it on a longer term basis, and this is something people don't think about, is currency markets really play that role as really kind of a global cleansing event. You see the dollar index, it moves in these long-term, trends like this. And of course, what this does, the dollar gets too high, of course it gets too low, like everything does. But in the currency markets, because currencies price real values on all goods in the world, when the U.S. dollar starts to get very, very low, and people are afraid of it, guess what happens? All of a sudden, the U.S. assets start to look very, very cheap. So if you're a major player in the international world, and you've seen the dollar falling down during bad economic times, it has pushed real asset prices down because of the economics, and they push down even further because of a falling currency. Pretty soon they get so cheap that people start pecking at them, start buying, and that's when so currencies play that role. They play that pressure valve in a longer term basis, of creating overvaluation and undervaluation, and investors start to come in, peck at U.S. assets We start to see longer-term fundamental direct, FDI flow because it says, hey, assets are so cheap and they have a longer-term time frame. Currency starts up, then maybe the hot money flow starts to come in, and all of a sudden there's expectations of interest rates being hiked, and then you see that self-reinforcing process on the upside. So always keep in mind there's a fundamental feedback loop, fundamental and price feedback loop in the currency world. One other thing, and I think people miss this, and especially for U.S. investors, because we're not used to trading currencies, having to buy other currencies when we move across borders and that type of thing. This is less of a problem with people that have lived in Europe for years or other countries that have traveled. This is a relative game. We tend to get a lot of financial news. I think we get too much financial news, and we tend to think our country's going to hell in a handbasket. Obviously, it's pretty good rationale, pretty good reasons out there to suggest we are going to hell in a handbasket. I'm not going to argue with that. But what we don't see is, and Steve and I were discussing this briefly before we started, is other countries in the world may be in terrible shape, and believe it or not, they could possibly be in worse shape than the U.S. economy. And currencies is always a relative game. You can't trade the dollar in isolation. You have to trade the dollar against something else. So there's where, again, your fundamental analysis comes into play to help you. If you can just glance across the pond and look at some of the other major currencies in the world and do some basic fundamental analysis, it gives you kind of perspective or a measuring gauge to say, yeah, things are ugly here, but they're pretty ugly over here too. So on a relative basis, maybe the U.S. dollar may not be so bad off. Again, I'm not saying that doesn't mean the U.S. economy may be in terrible shape, but on a relative basis, if another major economy in the world is in as bad a shape or almost as bad a shape, it doesn't necessarily mean the currency is going to tank or go down to zero against that other country currency, again, based on the global fundamentals, the relative fundamentals. So always keep that in mind. And I think if you do your fundamental analysis across countries, you'll start to understand this idea of relativity in the currency world. You hear a lot of people saying, a lot of news writers saying, and it's a real pet peeve of ours, the dollar is going to go to zero. The dollar is going to go away in 2 years, 5 years, 10 years. I mean, it's just total nonsense, and they do this to sell newsletters and things. The reality is that the dollar is the world reserve currency, and it doesn't just disappear in 2 years, 5 years, 10 years. The U.S. dollar will rally again. The U.S. dollar will rally again when the U.S. gets its economic house in order and the Fed starts raising interest rates. It's as simple as that. But who knows how long that takes? Do we go into another bear market? Maybe. Do we go a lot lower? Could be. But is the dollar going to go away? No. If the dollar goes away, guess what? All that gold that people are buying, they're going to be melting down for bullets because there'll be no financial system in the world left, and everybody will be scavenging, in an uncivilized way out there. So if you like gold and you expect it to go higher, but you want it to go higher and the dollar go to zero, the dollar is still the center of global finance. If it goes to zero, there's massive chaos in the globe. So just keep that in mind, and that's where the relativity comes in. And of course, the point I made before, don't think you can use the fundamentals to forecast. Always use them as just a balancing. What's the consensus see? What the fundamentals are changing. Is the consensus changing? Oh, the consensus is now starting to change or reflect some of the fundamentals that I've already seen. Allows you to move a little faster. Okay, that you're not trying to forecast with them, because none of us can forecast. No matter how smart we are, how smart we think we are, we can't forecast anything in the financial world. Ultimately, and Steve is very good on this, because I think Steve understands this better than anybody I know. Steve was a real deal, a real trader, and he understands what probability is about and can talk to this. And I think we had talked about it before. When we got most confident in a trade and most cocky is when we got hit the hardest, when we thought we could forecast. So always remember, try not to do that, and that in and of itself will keep you out of trouble. It's a probability bet.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.